Okay, good day, everyone. I hope you can hear me. Thank you very much for joining today's Asian Impact webinar. I'm Yasu Sawada, Chief Economist and Director General of ADB's Economic Research and Regional Cooperation Department. It's my great pleasure to moderate today's webinar on COVID-19 and dollar funding strains. I'd like to thank the organizers of this event and express my gratitude to our distinguished panelists, Mr. Hyun Song Shin and Ms. Alicia Garcia Herrero, for joining us this afternoon. Today's topic is very timely as the COVID-19 pandemic continues to spread. The strain on health systems, economies, and financial systems across the globe has mounted. In the region, the pandemic has heightened exposure of Asian banks to US dollar funding risks. A sudden tightening of US dollar funding liquidity can rapidly cascade to emerging market borrowers, a pattern that previously played out during the global financial crisis. Emerging Asia's dollar-denominated cross-border lending has increased sharply over the past decade, as has its exposure to US dollar funding markets. As a consequence, a sudden squeeze in US dollar liquidity can hurt emerging market borrowers and pose significant risks to their financial stability. While reforms made after the Asian financial crisis and global financial crisis have significantly improved the region's macro-financial resilience, much remains to be done. The COVID-19 crisis offers an opportunity for Asia and the world to regain momentum to reform their financial systems and address underlying vulnerabilities. Today's webinar will highlight potential avenues for reform and explore policy options that might meaningfully contribute to the region's future financial stability and resilience. We will begin with a brief overview of the issue based on the ADB policy brief published just yesterday, which can be downloaded from the ADB website, this policy brief, which will set the stage for the discussion from our panel of experts. A quick note for our viewers: you may send us your question through the Q&A panel of the Zoom that you can see on the right side of the screen at any time. So please send your comments using this Q&A panel, okay? And you may also like questions asked by other viewers. We will answer as many questions during the panel discussion as time permits. So let me now introduce my two ADB colleagues who will present their research work first. And also I'd like to introduce our distinguished panelists. So our ADB colleagues, Seon Park, who is hosting today's webinar, is Director of Regional Cooperation and Integration Division of our department, Economic Research and Regional Cooperation Department. She has written and lectured extensively about the Asian economy and financial markets. Her work has been published in peer-reviewed academic journals, including a Journal Banking and Finance, Journal Future Market, and Review of Income and Wealth, as well as the World Economy. Seon holds a PhD in economics from Columbia University. Also, our ADB colleague, another colleague from ADB, Peter Rosenkrantz, is an economist. He is also with the Regional Cooperation Integration Division. Peter's research has covered US dollar funding conditions, regional financial safety nets, and macro financial feedback effects of non-performing loans. Prior to joining ADB, Peter worked as an advisor on economic development policy at ZIZ and as a market infrastructure expert at European Central Bank. Peter holds a PhD in economics from the University of Zurich. Before Seon and Peter provide a background of this study, I'd like to now introduce our distinguished panelists today, who will be joining Seon and Peter's initial presentation. Hyun Song Shin is the economic advisor and head of research at the Bank of International Settlements, BIS. Before joining the BIS, he was the Hughes Rogers Professor of Economics at Princeton University. He also serves as a senior advisor to Korean president in year 2010, taking a leading role in formulating financial stability policy and agenda for the G20 during Korea's presidency. From year 2000 to 2005, Professor Shin was Professor of Finance at London School of Economics, and Hyun holds a PhD in economics from Oxford University's Nuffield College. We also have a panelist, another panelist, Alicia Garcia Herrero. Alicia is the chief economist for Asian Pacific at Natixis. She is an adjunct professor at Hong Kong University of Science and Technology, senior fellow at Bruegel, and a non-resident research fellow at Real Institute Elcano. She holds advisory roles for the Hong Kong Institute of Monetary Research, Asian Development Bank, and the European Commission. Alicia is a board member of the Hong Kong Forum and co-founder of Bright Hong Kong. Alicia holds a PhD in economics from George Washington University. So now I'd like to invite Seon for her first providing and making presentation about the background of this study. And then Peter has 15 minutes to present the main findings of the policy brief. So now over to you, Seon.
Thank you, Yasu. Well, the US dollar is the currency for international funding and investment. Globally, about half of all cross-border loans and international debt securities are denominated in US dollars. About 80% of foreign exchange transactions are against the US dollar. Dollar is also accounting for 60% of international reserves. Since the GFC, there has been a rapid rise in emerging Asia's cross-border financial activities, and so is its exposure to US dollar funding market. Given this large international financial activities, relying on the dollar funding and closely interconnected world of finance, exposure to dollar funding market create vulnerability to many emerging market economies, especially the ones in the region. So we have conducted this study to empirically show the impact of high dollar funding costs during the financial stress on capital outflows from emerging market economies. Without further ado, I would like to turn it over to Peter to share the mechanisms and also empirical evidence of this dollar funding vulnerability of the Asian banks. Peter, to you.
Thank you very much, Sin Yang. It's my great pleasure to present the main findings of yesterday's published policy brief on COVID-19 and how it exposes Asian banks' vulnerability to US dollar funding. This is joint work together with Sin Yang and also my colleague Mara. Next slide, please. So the main findings of this policy brief are that, as mentioned by Sin Yang, so a sudden squeeze in US dollar funding liquidity can actually hurt emerging markets, particularly during crisis periods, as we've seen during past crises, such as the global financial crisis, but also the ongoing COVID-19 pandemic. It can trigger a capital flight and thereby also poses risk to financial stability, in particular to emerging market economies. We also note that during those periods of stress, that those high and rising US dollar funding costs can force non-US global banks to curtail lending, including to emerging Asian economies. We've also noted a change in landscape of the global lending and borrowing landscape in US dollar, but I'll talk about that in a second in more detail. One main finding, as mentioned by Sin Yang, is we look empirically at the effects of US dollar funding exposure of Asian banks, and we find that it actually is associated with a rising dollar funding cost, and thereby also can impose some stress on dollar funding costs in emerging Asian economies. And we also find a positive and significant association between dollar exposure and capital outflows. And that also, of course, calls for close attention for possible associated increasing financial volatility in emerging market economies. And we finally provide some policy considerations. And we also want to make the point that this crisis also provides a great opportunity for policymakers to regain reform momentum, in particular regarding regional financial cooperation, but I'll talk about it in more detail. Next slide, please. So we note that in particular the non-US global banks, so these are banks engaged in US dollar funding activities without a stable US dollar deposit base or without access to US interbank markets or monetary policy operations, those are the ones who more rely on foreign exchange swaps, for instance, and particularly those emerging Asian economies. And one of the price or the premium for that, if you want to, during times of crisis or more generally any time, obtain a needed dollar liquidity, is the cross-currency basis swap, or the basis. And that is pictured on the right-hand side in the chart. And here we note that during the COVID-19 pandemic, the price of marginal dollar liquidity has risen in a similar way as it did during the global financial crisis. So this is the marginal dollar cost, and we see that particularly for emerging countries, we have there some on the left-hand side, those basis is a lot larger. So the dollar premium need to be paid by the bank or the economy that needs dollar liquidity is higher than for advanced economies, as we can see in comparison on the right-hand side, for instance, the euro or the British pound. And that calls, of course, for close attention. And we also note here that there have been some interventions by the Federal Reserve, in particular by reintroducing 9 temporary swap lines to a wider set of central banks in addition to the 5 standing swap lines, including Australia, New Zealand, Korea, and Singapore, and the region, that have somewhat eased stress in dollar funding market. In addition to the introduction of the repo FEMA purchase agreement, which allows for those central banks who do not have a swap line to exchange their dollar assets like US government bonds in exchange for needed dollar liquidity. Next slide, please. So why does all matter? Xin Yang has already introduced, despite US dollar only accounting for 10% of global trade or 25% of global GDP, the dollar share in international transactions is a lot higher, including in the reserves or FX. So there's a big and rising dollar market out there. And consequently, also Asian banks have increased their cross-border assets and liabilities. They have risen considerably, even in the aftermath of the global financial crisis. And those exposures are primarily denominated in foreign currency and primarily in US dollar. Second, the landscape of non-US global banks has also changed. It was primarily European banks of non-US global banks that were facilitating wholesale dollar funding globally before the global financial crisis. But more actors have joined this club, and also Asia more and more active in this regard. As an example, on the right-hand side, we see cross-border claims and liabilities of non-US global banks, and the orange portion is Asia, and we see that since the fourth quarter of 2016, Asia actually accounts for the highest share in cross-border claims denominated in US dollars. Japan is a very big contributor here, for instance, but also emerging Asian economies, others. Second, we also note that non-bank financial institutions have been more active in dollar funding activities. So it's not only the banks, but the counterparts of the banks are large institutional investors such as pension funds or life insurers, which of course have possible implications when we think about regulation or supervision and possible amplification of some shocks, and that need to be taken into consideration. Next slide, please. So given this large and rising dollar funding activities, which we can regard as a structural vulnerability, and especially for emerging Asian economies, we want to look at the effects empirically. And that's why we employed a cross-country data set with 39 economies, starting from the early 2000s until recently, the end of 2019. And we would like to assess the extent to which rising or high dollar shares has implications on dollar funding costs and how it evolves during periods of crisis and whether it can be acting as an amplifier with regard to financial stress. And we actually find that it actually plays a significant role. And second is we also relate these, the basis, basically the dollar funding costs with capital outflows from emerging market economies in particular. And we also find that they are positively and significantly associated, calling for close attention also regarding capital outflows during crisis. As we've seen, March, for instance, there were large capital outflows from non-residents experienced throughout the emerging world, including in emerging Asia. Next slide, please. So this is our first regression, just rather quickly to go through it. So the dependent variable is the basis. So the dollar funding cost or the premium you need to pay to obtain dollars in a cross-currency basis swap arrangement. And positive here means more stress or higher dollar premium, higher dollar funding costs. Excuse me, can you please turn one slide back? It's already the second. Yes. So the dependent variable is the cross-currency basis swap. And we find first the FSI, which is the financial stress index at domestic level that comprises a sort of an index of stress in debt and equity, but also FX and bank markets. And we find that this is not really surprisingly positively associated with dollar funding costs. So financial stress also triggers a rise in dollar funding cost. But more importantly, this is sort of the orange shaded variables here. We look at the share of dollar positions of banks. So this is BS data on the total bank's position in assets plus liabilities, but also only assets, only liabilities, and the share of which is denominated in US dollar. And here we find that the higher the share is denominated in US dollar, the higher is also the cross-currency basis swap, indicating that it has an effect on the dollar funding risks. And we also look at the interaction. So the financial stress index interacted with dollar share is positive. And this is quite of an interesting result. We find, in particular, for a given level of financial stress, that already exercises a stress on the dollar liquidity conditions, a higher dollar share even amplifies that further. Emerging market dummy is also positive. So it's primarily those emerging markets that are exposed to high dollar funding costs. And also the interaction between emerging markets and crisis is also positive. So emerging markets during periods of crisis are the ones most vulnerable to high and rising dollar funding costs. Next slide, please. And in the second regression, we look at now how is this dollar funding cost approximated by the basis related to non-resident capital outflows, which of course, can pose risk to financial stability, financial volatility, in particular in emerging market economies. And we do find a positive and significant association between the two, while controlling for regular push and pull factors. It survives total capital flow, that's BOP data. In particular, if you break it down to the respective components, it's primarily debt and bank flows that are triggering that are triggered through a rise in dollar funding costs. Next slide, please. And there's somewhat a summary of, in the form of a diagram of what we've done empirically in our policy brief. So the left-hand side summarizes our first regression, whereby this right-hand side, the second regression, again, the basis is the variable of interest, which we use as a proxy for dollar funding cost and stress. And you see that the driving forces are general financial stress, but also the dollar share on the left-hand side. And it also is positively associated with non-resident capital outflows. Next slide, please. So before closing with policy consideration, we thought it's also a good way to take a look at the global financial safety net. Of course, this is one of the ways in which countries can weather crisis and can weather dollar funding stress, or can obtain the needed liquidity during periods of financial distress. So of course, as a first line of defense is national foreign exchange reserves, particularly relevant. And they have risen considerably in Asia after the Asian financial crisis. Another line of defense already talked about is the bilateral swap line or central bank swap line, quite powerful, gained importance during the global financial crisis, regained importance now during the COVID crisis, especially with the Fed, but not only. Of course, also regional bilateral swap lines can be rather powerful and as a sort of safety net. Then there's a regional layer, so that could relate to RFA financing. So if we think about Asia, that could be Chiang Mai Initiative multilateralization, so multilateralized swap arrangement among ASEAN +3 countries that could provide needed liquidity during times of crisis. For the case of Europe, it could be the ESM, or Latin America, the FLAR. Additionally, as a regional layer, one can also think of the MDB finance, including ADB finance and its crisis response facilities. Those can be fast dispersed during periods of distress and thereby also relieve budgetary pressures of economies under distress. And of course, lastly, the global layer, which is the IMF financing, very important. And what we believe is important to take a holistic view that it's an interplay between those different layers that are complementary to each other, that need to be looked at from, let's say, from a holistic point of view, that they all are important to safeguard financial stability and global financial safety net to be strengthened. Next slide, please. So in conclusion, allow me to close with a few policy considerations, which hopefully also inspire a bit the subsequent panel discussion. So first, sustain market confidence is important and ensure adequate liquidity. So while the region's macro-financial positions remain sound, policymakers should also remain vigilant against financial turmoil. Second, financial safety nets need to be strengthened, as already touched upon on the last slide. So Asian economies need to deepen regional cooperation and consider to strengthen regional financial arrangement to prevent a crisis. I mean, if we again think about the CMIM, that could relate to strengthening its capacity, including, let's say the liquidity capacity, so 240 billion is at the moment, or as well as the surveillance capacity could also be another consideration. Of course, a very important lesson from the Asian financial crisis was the twin mismatch, currency and maturity mismatch, and that called for developing and nurturing local currency bond markets, in particular long-term. And there's been a lot has been done in the region already. However, there's still scope for broadening and deepening local currency bond markets, including corporate bond markets, to address existing and remaining currency and maturity mismatches in the region's financial systems. This whole topic we talked about, or we will talk about today, of course, reveals some fundamental issues with regard to the international monetary system, with being so much centered on one de facto reserve and one currency, which is the US dollar. And there, of course, can be certain considerations to tackle that and thereby reducing a bit this structural vulnerability. And lastly, so developing hedging mechanisms is, of course, important. And while they are existing to some extent in the region, that can, of course, further alleviate certain currency and maturity mismatches. So, I mean, that could help the region to mitigate currency and maturity mismatches, and having more efficient hedging mechanisms can be certainly on the policy agenda. Next slide, please. And yeah, I would like to thank you very much for your attention, and I turn over back to Yasu.
Thank you very much, Peter, and also for successfully summarizing policy briefs and also setting a stage for a panel discussion about the role of dollar-denominated funding and also financial vulnerability. So now I'd like to invite two panelists, distinguished panelists, one by one. And first, I'd like to ask Dr. Hyun-Sung Shin for his initial discussion. So Hyun, you have 6-7 minutes for your initial discussion.
Yes, thank you, Yasu, and thank you for the invitation to this very good event. Perhaps I could start with some broad introduction on the policy response. The COVID-19 crisis is actually three shocks rolled into one. It is, first of all, a health crisis. After all, it is a pandemic. And secondly, we had an economic sudden stop in the early days, especially March, partly due to the lockdown measures, but also very much due to the changes in behavior. And that meant that the economic activity slowed very sharply in March and April. And thirdly, we also saw that, especially in March, we had a financial sudden stop when we saw very sharp stress in the financial markets. And as Peter was describing, we had very much a shock in the dollar funding markets more broadly. And you can see that as being part of the stress in the broader financial system. The policy response this time around has been very aggressive, especially in announced fiscal packages. And I think this is perhaps one of the welcome surprises compared to the much of the policy discussion we've had before. It's a shock that actually originates from the real economy, and then the financial system is affected by the slowdown in activity. It's very different from what we saw in 2008, which was a financial crisis with the epicenter in the banking system, which then impacted the real economy. And what this means is that whereas in 2008 there were direct levers of control for the central banks to address directly the stress in the banking sector, for example, through direct liquidity provision, or through the role of central banks and supervisory authorities using the supervisory powers. This time around, the affected sectors are the real economy sectors, which are one step removed from the banking sector. And therefore, actually reaching those at the sharp end of the shock has been a challenge. And this explains why it's been the fiscal packages which have played a much bigger role this time. So this chart shows the budgetary and the non-budgetary fiscal packages expressed as a percentage of GDP. And the non-budgetary measures include things like guarantees and funding schemes rolled out by the government through the central banks and through other lending agencies. Broadly speaking, the budgetary measures have been in the order of 10% of GDP for the advanced economies. For the emerging economies, it's been of the order of 3% of GDP. So it's much less, so it's a much smaller package. The non-budgetary measures in the advanced economies have been of the order of 12%. So together, it's around 22% of GDP, just in a space of a few weeks, which is really unprecedented. For the emerging market, it's a far smaller package. It's of the order of 2 to 3%. And I think this is a theme that's worth thinking about, because the shock, it is not because the shock was smaller in the emerging economies that the response was smaller. The incidence of COVID-19 was initially smaller in the emerging economies in the early stages, but what we've seen in Latin America especially is that it's now very much larger in emerging economies. So the smaller policy response, I think, is something to be explained. And here I'd like to draw the comparison between the Latin American, let me see if I can use the, even among the emerging economies, there's a difference between those in Asia and those in Latin America. And we see that the debt levels between the Asian and the Latin American EMEs are also different if we look on the right-hand panel. Perhaps perhaps the most notable policy response this time round has been the actions of central banks in the emerging markets, in the sovereign bond market. We can perhaps go into the details later of the currency denomination of the sovereign bond market, but as you all know, and as the ADB has played a very important role in the sovereign bond market, close to 90% of the sovereign bonds are issued in domestic currency. And so the currency mismatch that is implied by original sin has well and truly been overcome. But this has not been enough to insulate emerging markets from shifts in the exchange rate. And I think the reason can be found in the response of the global investors to exchange rate changes, because the currency mismatch has migrated from the borrower to the investors, in that the investors typically hold an unhedged portfolio of emerging market bonds, even though their obligations to their policyholders and to their beneficiaries, if you're a pension fund, tend to be in other currencies, so in hard currencies, US dollars, euros, yen. And what that has meant is that as the exchange rate changes, the investors face an amplified gain or loss. And when risk appetite is also diminishing at a time of financial stress, this means that the investors typically sell. The response this time around in monetary policy has been really quite remarkable, because what we see in the right-hand panel is that monetary policy has actually been eased this time around. In that interest rates have been cut. This is the red line. And in addition, central banks have intervened in the market directly, and there have been bond purchase programs to restore market functioning in the sovereign bond market. So the blue line indicates the number of countries that have announced bond purchase programs, and we recently published a bulletin on this turn of events. The amounts are still small, but we think this is a very significant move, because it gives a shift, yet another shift in the policy response of emerging market central banks to financial stress, in that rather than being conscious of the exchange rate, which is on the left-hand panel here, the impact on financial conditions has been given much more emphasis. And I think it is another chapter in the evolution of the playbook of the central banks in the emerging markets to financial stress. So let me pause there and give the floor to Alicia. But we could come back to the issue of the sovereign bond market and dollar funding, perhaps in the course of the Q&A. So Yasu, let me stop there.
Thank you very much, Hyung, for giving us a broader background arising from government coping with the pandemic, and also a situation about market conditions, environment, Asia and around the globe. Thank you very much. So now I'd like to hand over the microphone to Alicia. Again, Alicia, can you discuss, provide your initial discussion for 6-7 minutes? Alicia, floor is yours.
Thank you so much. It's a pleasure to have been invited to this very interesting event. I have to say that this is a topic very close to my heart. I've been worrying about dollar liquidity for very long, both as a market participant working for an investment bank, but also as an economist as early as my early life at the IMF with the Mexican crisis in '94 and thereafter. So, this is a topic that I think deserves discussion, especially at a time, where we have literally a global shock like the COVID-19 pandemic. So I'm not going to repeat myself, because what we heard already is a lot about where are we. We are in a global shock. I think I fully agree that this is now underestimated by the market in the sense that the EM shock is actually bigger than we see in the renewed inflows into EM, which means that we've gained some time, which is great, but we don't have an answer. I want to go straight to the answers. And there we've heard from this very interesting ADB paper, which I will recommend everybody because it does list all of the options, and that we humbly also worked on in a paper published by CPR, a short version and then a longer version by Bruegel, on the options for EM in the light of dollar liquidity shortage. The first comment on this paper that we got is that, oh, there's no such thing as dollar liquidity shortage because of the reason Hyun just mentioned, which is now debt is in local currency. But frankly speaking, this is a mirage. And I want to start by saying this is a mirage because even if perhaps countries are indeed less subject to immediate balance sheet effects, and I think this is, by the way, the reason why we are having more expansionary monetary policy and thus pro-cyclical, if I may say, counter-cyclical rather than pro-cyclical monetary policy, as in many other crises in the past, thanks to the fact that the balance sheet effects, i.e. that the external debt, dollar debt, is smaller, doesn't, however, solve the problem. It only minimizes the impact of exchange rate depreciation on the stock of debt, which is good. I think this is one of the reasons why central banks were dared respond more proactively. One more piece, and sorry for the publicity that we published also CPR Vox piece, is that we argued they could even go further a little bit on QE, those credible central banks, maybe not every central bank. But once you go past that, meaning that you've exploited what you could do in terms of monetary policy expansion, because you really can't do anymore. Either rates are already very low, or the interest rate differential with the US would push your currency just too low to depreciate it. That's where we start talking about the options the ADB paper starts discussing, i.e., of course, self-insurance, regional insurance. We could, of course, also talk about capital controls, and we may have different views on these, but it is indeed one option. Well, we do not favor that option in our paper, but I don't want to get too much into that corner now. I just want to talk about the options we offer, and then talk about some kind of wild cards, because I think we need to start talking about wild cards. The dollar shortage problem is not solved; it's just dormant. It's dormant because the base has gone down thanks to the Fed partially. Let's face it, it's not only the Fed, because the withdrawal of swap lines is actually at minimum levels, meaning there's no need now. It's not about supply, it's about demand. There's no need. And a lot of that need, by the way, was in developed economies. Australia was a very obvious example, even Japan, because of the lending, dollar lending or dollar investing part of the lifer and bank's balance sheet. So just bear with me. What I'm trying to say is that this dormant problem needs solutions. Beyond QE, which I started with, which I think is basically close to exhausted, or of course, interest rate cuts and then some QE for EM, close to exhausted. Maybe some central banks can do something more. We had the Bank of Thailand, we have Bank Indonesia with getting into the primary market, but it's not. They can't be the Fed. They can't be the ECB. It's just not possible. So the other options listed in the ADB paper, capital controls, as I mentioned, but then self-insurance reserves, regional insurance. We show in our piece for Bruegel that let's be frank. They are not as big as we think they are. They're bigger in Asia. They're nowhere to be found anywhere else, given the size of the economy, Africa and Latin America in particular. So they're only a partial option for Asia. And if we look at reserves to GDP ratio, it's actually coming down very aggressively because of the sheer size of emerging Asia so far, and the fact that, yes, reserves have grown, but not at the speed of the economy. So I'm just trying to pass on this message. it's not enough. What else can we do? Then we have, of course, the Fed. We already have swap lines with 9 central banks. We have the repo, but the Fed can't be the world's lenders of last resort in dollar. I don't think we can expect much more from the Fed, to be frank. And they also have their huge domestic commitments. If you think about it, so, their balance sheet is already growing beyond what one could even imagine. So no more to be expected, in my opinion. The IMF, and we didn't talk too much about the IMF, very, very briefly, our paper focuses on the lack of instruments by the IMF, including even the recent short-term liquidity facility. It's just that it's only 145% of quota. Is nothing for a country of the size of Brazil's financial market and its exposure to the world. Is just not enough. So if the IMF is not enough, and I don't think we can think of not only increasing new SDR or even switching quota, that's going to take too long. We need immediate decisions, immediate solutions. So if the IMF is not an immediate solution for the 100+ countries that are queuing, what can we do in the light of a potential renewed dollar liquidity shortage? And there, I mean, this is just wild cards, bear with me, because I don't have the magic wand here too. But I think, and I'm really happy to be invited to this event because it's right there on you. I really think, and Europe has an experience, so I was asked to talk a little bit about Europe, that's where I link it. I think development banks have done a great job in infrastructure, in education, in many things that are surely very important long term. But all of those things can really be hurt, to say the least, if we can't control a liquidity crisis in the EM space, be it Asia, be it Latin America, much more likely, in my opinion, anywhere else. We even have, by the way, dollar peg somewhere. You see, I mean, this is even riskier. I'm not even thinking about Hong Kong. I mean, it's many others. Yeah, it's not about geopolitics. It's about a sudden shortage of liquidity or a massive capital outflow, etc. So I think policy banks have a role to play, because even if this is a kind of IMF type stabilization type problem, it relates directly, and the IMF has learned the lesson, to debt dynamics, even if it's not dollar denominated, because at the end of the day, you need to serve those foreign holders of your domestic currency debt in a way or another. If they want them to come back, they need to make sure there's an exit. There's an exit to your local currency exposure. You need hedging, we heard about that, but you also need to make sure that there's enough dollars for you to get out. And that's why it's a dollar problem anyway. So we need more dollar liquidity, and I think policy banks have a role to play. I finally link it to Europe, as I mentioned before, by saying that, and this is an old story, and Japan was once upon a time very keen on this. We Europeans had a massive crisis, as you all know, in 2010, 2012, European sovereign crisis. ESM was created after several attempts and several different animals, put it this way. And now we have what we could call, if we wanted, just we didn't, a European Monetary Fund. We do have that. And it can serve the purpose, as it's going to serve the purpose in a way, jointly with the European Rescue Fund, if used for rescue, i.e. development growth, medium and long term, but it's also going to be used, if requested, if countries request it, as a liquidity tool, I may say, as a stabilization tool. So here the key issue is, if we can't really distinguish between liquidity and solvency, and the IMF is right there with this problem on the top of their head, because all of these liquidity assistance programs, including the latest, basically are based on still debt dynamics being basically sustainable. So if we can't distinguish the two, especially after, in the light of a pandemic and how all of the variables we know change from growth to inflation to interest rates, can't we then use these stabilization institutions, i.e. IMF, and policy banks, more growth-related institutions, in a way that they pool these resources together in the right way at the right time, including liquidity needs. Because I don't think the market is ready to do it all by itself, creating these wonderful hedging instruments in the midst of what we are going through. So we need more institutions, I think, involved in this very key issue of dollar liquidity shortage in the EM space before the next wave comes. This is not about the pandemic, it's a financial pandemic. And we are all into this because, as you pointed out, the dollar is our reserve currency. And thus we can't, I mean, it's great to think of diversifying a way, but it's not going to happen now. If anything, it's going to be even higher, the dependence from the dollar during the shock. So since we can't change that in the short run, let's find solutions which are short run solutions to this short run problem. Thank you very much for your time.
Thank you very much, Alicia, for pointing out, somewhat echoing message by Hyung, that policy space in fiscal side as well as monetary sides are narrowing in responding COVID-19. And now a challenge is how to undertake effective policy options. And also, thank you very much for reaffirming a role of a policy bank like ADB. But I'd like to, Alicia, I'd like to ask you some fundamental question from different angle. This policy brief focusing on potential risks and vulnerability arising from US dollar funding, and why do Asian banks remain so much vulnerable to US dollar funding risks, in spite of the fact that Asian financial crisis, these banks are supposed to be strengthen their external positions, but still we see ever increasing vulnerability against the US dollar funding. So I'd like to ask you this fundamental question, and also relatedly, actually from the floor also, why there is still a liquidity issue or liquidity shortage, even when the US is printing a lot of fiat money. So can you respond to these somewhat fundamental questions, Alicia?
Yes, just an attempt to respond. I'm sure that Hyun-Shin can add so much more, but on the first, I think it's a question of size, relative dimension that we need to realize. Chinese banks since 2008, the latest global financial crisis, have been growing their balance sheet by 30% a year at the very early steps of the huge stimulus, and then slightly less, but always above their huge nominal GDP growth. So, we have bank assets in China now over 300% of GDP. And their international role, we have some data for commercial banks in China, is something of the order of 5 to 6% of total assets abroad. So, their needs are growing. I can make the case of Japanese banks. It's much smaller. It's, I think, 1.5% of GDP of total assets are overseas assets. Of course, lifers and so on, much more. But it is growing. So first, of course, the overall size is not true for Japan. It's true for China, but it's true for whole EM Asia. Their banks are becoming bigger. But for Japan, it's about the share of foreign assets. And that's, you need funding. You basically need funding because, there's a limit to the dollar liabilities you can have. So you can have dollar shortage, quote unquote, even when you are a current account surplus. I mean, at the banking sector level or at the lifers level. Think about Taiwanese lifers. 60+% of their assets are in foreign currency. So, the massive hedging you need. So all of that creates needs in Asia that weren't as big before. So it's a complex reason. It's first, Asia is bigger, their needs are bigger, their banks are bigger. And second, the specific case of Taiwan and Japan, and increasingly even Korea, is that as you age, you get more foreign currency assets because you need more yield. That requires, because you need to match your balance sheet, requires liabilities in dollars, and that's you need to get them. So in a way, it's a complex reason, but it shows that there's many different reasons why this is happening. Well, on what to do, your second question, I just think that there's two things. Asian markets are too big for their sophistication in terms of dealing with forex risk. This is very important. In markets, we see this all the time. It's just there is like a disconnect. And then there's partial capital controls here and there, different nature. So it becomes kind of tectonic. I mean, the changes are more tectonic than elsewhere. Latin America has, on average, a much more open capital account, generally. So the changes are not as tectonic. I don't know whether I'm answering your question, but I just want to say that Asia wasn't in the loop before because of all of these reasons. It's in the loop now, rightly so. But it is also the most resilient region in terms of, as I said before, independent, basically self or regional insurance and the like, and even more, fewer imbalances. So in that regard, it's more protected, but it's just more in the loop because of its size, the size of its banks, and the reasons I mentioned. I hope I've answered the question.
Yeah, thank you very much. Yeah, so I think we can talk about how policy and policy reform should be undertaken in the context of emerging Asia in comparison to Latin America. So I think we will come back to this point later on. So now, Hyuk, I'd like to ask the same question: why Asian banks remain vulnerable? Even after lots of initiatives and reforms after Asian financial crisis, and especially related to this, I'd like to also ask you lessons from Asian financial crisis related to a double mismatch, currency maturity mismatches, still applicable to the present context. And also, I think you kindly refer to local currency bond market developed continuously after Asian financial crisis, and with contribution, and also there is a substantial contribution played by ADB in this nurturing local capital market. But I'd like to ask you this question: relevance of double mismatch lessons, and also why Asian banks are still vulnerable against the US dollar fundings.
Thank you, Yasu.
So
let me just illustrate my discussion with maybe another set of charts that I think will be quite informative for you. And what I will do is answer your question in two parts. Firstly, how much progress have we made in the government bond market? And in particular, how much progress have we made in addressing the double mismatch, namely the currency mismatch and maturity mismatch? I think in terms of the currency mismatch in the sovereign bond market, emerging markets have made tremendous progress. And you can see it in terms of this chart, which gives you the proportion of the central government bond market broken down into types of sovereign bonds. So the red bars are the foreign currency sovereign bonds. It's true that Argentina, Turkey, and to some extent Indonesia still have large, sizable dollar-denominated sovereign bonds. But for the vast majority of other emerging markets, local currency is the norm. This is just in proportions, but to give you a sense of the magnitude, here is the dollar amounts. And I have now ranked them in terms of the size of the issuance. So here we have Brazil firstly, and then India, and then Korea. Among the domestic currency bonds, there are the different types: floating rate, inflation index, just a straight, fixed rate, etc. But you see that the lion's share of the central government bond markets are in local currency. And this is a very different picture from what we saw during the Asian financial crisis. And because these bonds typically are long-term, there are some very long-term bonds, but they're certainly several years in maturity. Therefore, the maturity mismatch is addressed. What hasn't been addressed as much is the development of the domestic investor base. And we see it from this chart where we ask how much of the local currency government bonds are held by domestic investors. And it turns out that still non-resident investors have a very large holding. And the dots here indicate 2009, the bars indicate the situation as in 2019. So the various initiatives spearheaded by ASEAN +3 and ADB has played a very, very important role in all those initiatives, has solved the currency mismatch. But still a large proportion is held in the hands of global investors, which sets up this migration of currency mismatch that I referred to earlier. And I see that my colleague Il-Hyok Shim is on the call. We have a BIS bulletin which addresses this. It's called Original Sin Redux, and the idea is original sin in the original sense has been overcome, but original sin has returned in the form of a currency mismatch on the part of the investor balance sheet. So they're holding emerging market sovereign bonds on a naked basis rather than having gone into it with a hedge. I think we still need to make progress in establishing emerging market sovereign bonds as a sovereign bond where investors enter on a hedged basis. And this leads to my second point, which ties in with the remark that Alicia made, which is a very important one. Which is that if we look at the dollar strains, dollar funding problems are primarily an advanced economy issue, in the sense that, and I didn't prepare this particular slide, but if you look at BIS Bulletin number 1, that's the one that we published on the 1st of April. And we look at the BIS derivatives statistics. The swap contracts have increased manyfold over the last 10 years. And it's been driven primarily by the hedging demands of fixed income investors. And when we look at the currency, we see that the euro is the largest. And then the yen is also a very large counterparty currency in dollar swaps. And as Alicia mentioned, what we see is that the long-term investors who have obligations to policyholders and to beneficiaries in domestic currency, so in euros or Swiss francs, have to hold a globally diversified portfolio, among which the dollar-denominated fixed income instruments are really a very large proportion. So if you have a fixed income portfolio that has primarily a dollar exposure, but you have to meet obligations to your domestic policyholders and beneficiaries in your home currency, then you need to hedge. So typically, when advanced economy investors hold fixed income instruments denominated in dollars, they do so on a hedged basis. So they enter into a swap with a bank, and then with the proceeds of the swap, then purchase the dollar-denominated securities. And it's this, and so there's a demand for dollars, which comes from the portfolio investors. And the supply of dollars comes from the banking system. And I think this is where the banking sector dollar funding stresses really matter most, in that during crisis times, we see that the dollar supply through the banking system is under a great deal of stress. And this is what we also saw during the middle of March, when we saw that the banking sector really contracted very sharply. And as Peter was showing, it's the cross-currency basis, the deviation from covered interest parity, which showed up in those currencies where the investors are entering the dollar fixed income markets. And as Alicia rightly pointed out, in Asia, traditionally it's the Japanese long-term investors who have been very important. But increasingly also what we saw is that Korean investors have been a very important player. And in fact, the Korean cross-currency basis, the dollar Korean won basis, widened to 270 basis points at the height, which is really unprecedented. And it's a reflection of the growing depth of the domestic investor base in Korea and the aging of the Korean investor profile, which means that there is more of the money to be invested. And the domestic government bond market has a limited scope to absorb some of these investor flows. And there's also the yield differential, which also enters. And so I think when we look at the portfolio flows and we look at dollar funding strains, and in particular why the banking sector still suffers from these episodes of dollar funding stresses, we can count the overcoming of original sin as a success, but there is still a weakness in the fact that long-term investors, the portfolio investors in the region, still needs to hold a large amount of dollar-denominated securities. And there is a very large hedging demand. And the hedging demand has to be met by the banking sector. And so we can, Yasu, maybe we can turn at the end to the policy options that flow from that. But that would be the diagnosis.
Thank you very much, Hyung. Before going to the policy discussion, one related question from the floor, asking something about internationalization of renminbi. I think this has been there in last 1 decade or so. But not only China, but also Korean long-term investors playing a role, and Japanese traditionally playing a role. So what do you think about independence from US dollars switching to Asian currency, notably renminbi, Korean won, and Japanese yen? And is there any scope for aiming at this? Although COVID-19 epicenter has been China, and then East Asia has been affected at the initial stage. But so this is a related question from the floor. What's the role of Asian currency sort of mitigating a potential vulnerability against too much US dollar dependence? So this is a question if Hyung can quickly respond, or other Alicia or Peter and Sion, if you have some quick response before getting to the policy discussion.
I think there has been some progress in this direction already. If we look at the financing of trade, there has been some progress, although the dollar is still the primary currency for invoicing, and therefore there is still a great deal of reliance on dollar funding on dollar funding of finance, on dollar funding of trade. But the important point is that the preeminence of the dollar is not a statement about. It's not just a statement about the importance of the United States as an economy. It is more about the dollar as a convention, as the outcome of a collective action problem, which has to do with many different web of contractual relationships. And still, by far, the most common currency for contractual relationships is in the US dollar. And for that reason, it's difficult for any marginal impact to be made when everyone is coordinating on a particular currency in the short run. So maybe in the medium to long run, we could see that switch. And the preeminence of the dollar in the fixed income market also reflects that, because the contractual relationships reflect both the interests of the borrowers and the lenders. And if the borrowers borrow in dollars, then there are assets that are denominated in dollars. Typically, the dollar-denominated securities, especially the fixed income securities, tend to be over 50% of a globally diversified portfolio. And I think what this means is that, so let me just pause there, and then we can go on to the policy options later.
Okay, thank you very much, Young. Now let's switch a gear and talk about policies and regional financial arrangement. The first question I'd like to ask is about, as Peter presented in a nice chart showing that there is a strong multi-layered global financial safety net. It's necessary. So maybe this is the benchmark. My question is the current regional financial safety nets arrangement, is it really enough to cushion the impact of a potential financial turmoil induced by a COVID-19 pandemic? Because again, all the country started putting a large-scale stimulus package in order to soften negative consequences of stress on household debt as well as business, accumulated debt. But this may induce one hand accumulated sovereign debt issues, and the other one is household and corporate level accumulated debt, and also potentially accumulated non-performing loan problem. So how to what's the role of regional and also global, nested into the global, and also national level self-insurance kind of schemes? So the question is it enough to protect against emerging risk of financial turmoil? So I'd like to ask this question. Maybe we can start from Alicia. Alicia, can I ask you this question? Is it enough?
Good question. My answer would be utterly no, but that's easy. So I'm going to rank countries according to, or at least areas according to how much, because it's always no. Yeah, we are in a pandemic. We're close to a second wave everywhere, and it's hard to argue that the bullets are enough if we can't even measure the problem yet. So I think as long as you have a reserve currency, and by that I mean the dollar, the euro, even the yen, I mean any currency that has a central bank that can expand the balance sheet without the need for capital controls, i.e. that can somehow manage the currency consequences of that expansion, whether fiscal or monetary, in a way that is sustainable, I think for me can do. Not that they have so far done enough. I can't judge because I don't know the size of the problem, but can do enough. So I would argue that if there is a policy will, if there is a will, there is a policy solution in countries of that order. It so happens there are very few in Asia. Yeah, I'm not sure where I would place Korea. I leave it up to Hyun-Shin to argue. But in my opinion, in Asia, in this first group, I would clearly put Japan and maybe no other country, not even Australia. Okay, so then we move to the second group. The second group are countries, and this is Korea, this is China. They're different, but what I mean to say, savings, bigger savings than investment, and possibly at high level, meaning that they can support growth domestically, and they can use that difference in whatever way possible, whether it is actually keeping as much as possible their growth domestically. I think we're seeing that in China in terms of what you see with imports and exports, and even more so if with the support of capital controls in the case of China. So basically, even if maybe their currency is not of this nature, reserve currency, they can act as a mimic of that based on the fact that they can have enough savings to keep at home by, I would say, steering, I don't want to say managing, the current account plus capital controls. This is the second group. I don't want to say Korea is that, I just wanted to say that it has a current account surplus. So this second group could still manage, in my opinion, because they have enough room in terms of using those extra savings. But the rest, and this is basically virtually many countries in the world, especially in Latin America, in Africa, and low saving and current account deficit countries, I think they're, frankly speaking, we need global safety net. I don't think they can manage these. Some may have some credibility. They can use their central bank balance sheet. I'm thinking about, very few. Maybe Banxico can do that. For how long is hard to tell. So, Mexico, but very obvious, kind of naturally protected, whether it's through the US or, an immediate liquidity assistance line through the IMF, as has happened in history. The rest is, to me, below water. Thus, we need a global financial response for this. And I won't extend any further. We can talk about what kind of response, but I just think we need to distinguish, you see, where the water is above the neck or below the neck. Most EM economies are below the neck. We may not see it now because of the market reaction, but my take is that's where we are.
Thank you, Alicia. Actually, there is a related question from the floor. So there is a different layer, self-insurance, depending on the country, self-insurance, and also bilateral credit banks, swap lines, regional schemes, and global scheme through IMF financing. There is a different layers of financial safety net. And then a question from the floor. I'd like to ask Hyung about this question. Should there be a systematic interaction between banks, non-bank investors, national authorities, and regional authorities? So this is a question: how multi-layered social safety net we are in the progress of strengthening, and on top of this, how bank, non-bank investors, and other stakeholders should be really interacted systematically. So, Hyung, I'd like to invite your response to these issues.
Yes, let me just refer to a couple of slides in answering that question. We referred earlier to, let's see. So these are the fixed income, the central government bonds that I was referring to earlier. 91% is in domestic currency. And so there is, and also these are fairly long maturity. So there's been a great deal of progress in tackling original sin. You see in this chart that for countries like Thailand, Korea, Malaysia, India, it's almost all in domestic currency. The reason why we saw that the financial conditions tightened when the dollar strengthened was the behavior of the global investors who entered these markets on an unhedged basis. So I think one question that we have to address is there a way of encouraging global investors to enter on a hedged basis so that they feel less need to exit when financial conditions tighten? And this is a very important issue because if the investors enter on an unhedged basis, it's the selling and leaving, or indeed ex post hedging, where you enter a forward contract after the event and thereby buying dollars and selling the local currency, which puts pressure on the domestic currency. So the exchange rate pressure arises from this ex post hedging or risk aversion behavior of the global investors, and that would be considerably mitigated if you can encourage the global investors to enter on a hedged basis. I think this is still a work in progress, because I think there is a classification that market participants still use, where developed markets are limited to a very small number of advanced economies. And for the countries in the region, even if they have very strong fundamentals and sound financial systems, tend to be grouped as the emerging markets, and they are typically classified as a risk asset, which you enter perhaps just before you enter the emerging market equity space. And in the exit, it tends to be sold in that sequence as well. Now, one way to encourage greater hedging would be to make sure that the hedging costs are lower. And typically what happens is the bonds themselves are long-term. They're 5 to 7 year maturity, but the hedges are shorter. They are 3-month hedges. They're rolled over. So the slope of the yield curve turns out to be a very important factor in this. So indeed, when we look at the monetary policy response, it could be that cutting rates and thereby steepening the yield curve is a way of encouraging greater hedging, both ex post and also on the exit to mitigate the selling. The other aspect that is important is the response of the central banks in the region. What we saw this time round was that the emerging market central banks did not follow the previous playbook of raising interest rates and tightening monetary conditions in order to arrest the decline in exchange rate. Instead, what they did was to loosen monetary policy, cut rates, and they also intervened in the domestic bond market by intervening directly and cushioning the selling pressure in the bond market. And we have a bulletin, it's bulletin number 20, which is a study of that episode. And what we find is this was a very successful episode of central bank intervention. It's sometimes called QE because it is government bond buying directly, but the scale was very much smaller. And the intention here was to restore orderly market functioning rather than to use balance sheet policies as a monetary policy tool to stimulate the economy. But in this surgical way, these episodes were very successful, and that's our assessment. And I think what this gives us is a very important lesson, that in the short term, you can loosen monetary policy, you can intervene directly in the bond market to purchase bonds, but from a financial stability perspective, in order to restore order in the government bond market. What that means is it sets off, rather it prevents a vicious circle where currency depreciation leads to more selling, which leads to higher bond yields and higher interest rates, which yield to greater distress, and which leads to even more selling. So that's a vicious circle. If you can intervene and cushion the flow, and in particular intervene in order to arrest the depreciation of the exchange rate, this can inject a stabilizing force. And I think what we saw in March was a very good example of that. That's a short term. In the medium to long term, there has to be structural developments, and in particular, there has to be efforts to encourage global investors to enter domestic currency bond markets on a hedged basis rather than on an unhedged basis. And I think there has to be an effort to develop the derivatives market in fixed income instruments. And last but not least, and perhaps most importantly, there has to be an effort to develop the long-term investor base domestically. So it could be a government pension fund, it could be local life insurance companies. They are the natural buyers of domestic fixed income instruments in that they have obligations in domestic currency. They have bond-like obligations in domestic currency, which are best met by domestic currency bonds. So I think that's the way that I would lay out the policy. So in the short term, there's a monetary policy response, there's intervention in the bond market through central bank purchases. In the medium term, firstly, develop the derivatives market, and secondly, develop a long-term investor base.
Thank you, Hyung. That's very nice segue to final question about what policy action can be taken to mitigate vulnerability. And you already answered this important question. But I'd like to again ask this question because as stressed by Peter's presentation, crisis, probably I can say crisis is the mother or father of important reform. So I think we need to envision right direction of the reform. So what kind of policy actions can be taken? For example, some countries now weak fiscal space, narrowing fiscal space because of a large scale stimulus package, income support and revenue support of firms and household, and also at the same time large external debt servicing. In this situation, what policy recommendations we can envision, and also broadly, what policy action should be taken? So I'd like to ask this question to each presenter and for each presenter and panelist, and actually starting from original sequence from Seong. And Seong, in responding to this, what's the policy actions, needing policy actions, please also refer to recent or some US dollar funding stress seen in the Korean market, and overall US dollar funding vulnerability. You can return to original motivation behind this policy brief, and then please spend the 2 minutes for your policy action recommendation. So Seong, over to you.
Thank you, Yasu. Well, I think our panelists have already repeated quite a lot of important points, but fundamentally, the explosive growth in the cross-border banking and financial activities and increasing participation of emerging Asia and Asian banks and then non-bank financial institutions to some extent due to a rapidly rising aging population in some advanced Asian economies are really the underlying cause for the strong dollar demand. But this is really a structural sort of vulnerability. First, relying on the wholesale dollar funding market for non-US banks is really just a structural sort of weakness. This is what I sort of mentioned as Achilles heels of this global financial system. They tend to be very short term. They tend to be highly volatile, especially for non-US banks who do not have a stable dollar deposit base. And do not really have access to Fed discount windows or repo facilities. These are going to be fundamentally just the exposure to a rollover risk during the financial stress. These also has actually 4 different dimensions of risk. It incurs the liquidity risk, it incurs the currency risk, it incurs the maturity risk, and it also incurs the credit counterparty risk. So these are really fundamental sort of weaknesses of a global financial system. But are we going to somehow reverse that the globalized world of finance? That's where our dilemma is, since that it's it's not really a solution. to go back to just the national currency-based funding. Even if we develop the local currency bond market, that over the long run, we really need to much more stressing on nurturing the institutional base, and then for a longer term, also the supplier, like the longer term suppliers, these institutional investors who will buy these long-term the debt securities in the local currency. So this is a longer-term solution, and then it will be gradual. But fundamentally, we need to strengthen more procedure, and then also how to nurture the institutional investor base, and then broaden and deepen the secondary trading of the local currency bond markets. It also, from our side, is important to develop and also foster the hedging market. Both on the demand side, like the non-US borrowers, and then also the non-US lenders are not hedging enough. They do not hedge, perhaps also because they would like to have a higher returns on hedged position. But the flip side of it is because the hedging cost is higher. If they hedge enough, then the returns for their investment are going to be lower. That's why they don't hedge. Why is our hedging cost so high than in Asia, in the Pacific? Alicia also alluded a few points, but the point is, while we are focusing a lot on the development of local currency bond markets, we have not developed enough of the local currency money markets, domestic money markets, and then also domestic OTC derivatives and then swap markets. While there are a large FX, transaction FX, actually the forward and then the swaps are globally, then in Asia, these are very much contained. It's still very underdeveloped, that somehow limit the ability of the banks and the non-bank financial institutions from hedging their investment in the local currency, or if they want to invest overseas. So these two areas are really it's a somewhat mitigating policy options over the long term if we want to continue globally active in international trade and investment.
Thank you, Si-Young. We are running out of time, unfortunately. So now I'd like to invite Alicia for maybe 1 minute on policy actions.
Sure. So I agree with Hyun-Shin and on the short-term solution being more bond buying, like run independent monetary policy. That's basically his message. And then on the structural part, which is exactly what we heard now, create money markets, swap markets, all kinds of hedging. But to do that, let's be frank. The capital account, you need to take a decision on the capital account. So it's not that that Asian authorities don't know that they are there. It's that they dare be somewhere else, because that means they control liquidity and their currencies less. So it is a policy decision, if you see what I mean. It's not only a developmental decision. Finally, in between, and I leave it there, we need to do something. It's not enough to do buy some bonds. I mean, it might be enough for some central banks, maybe Bank of Thailand, maybe not for Bank Indonesia, to be frank. Meaning, some central banks might not manage to get to the long term with a short-term solution, i.e., independent monetary policy. Thus, we need some global safety net to be pulled up more than what we have. And I insist on the role of policy banks and development banks like yourself to do that, because the IMF won't be enough for this purpose. So I want to leave it with that message. Thank you.
Thank you. Thank you very much for mentioning potential role of ADB and Regional Development Bank. With this, we'd like to conclude today's webinar. Thank you. Thank you very much to our distinguished panelists and presenters. And also thanks to the viewers for today's meaningful discussion. You can watch this video again through our website. We would like to invite you to our next Asian Impact webinar. Title is Restarting Economies and COVID-19 Control, Letting Loose Without Letting Up. This is focusing on the micro level policy options to reopen economy. And we will have this event 28th of July from 2 p.m. to 3:15 Manila time. So this is an announcement for next webinar. But again, thank you very much, Alicia, Hyung, and Seon, Peter, for a great discussion presentation. And please join me to thank today's panelist presenter. Thank you very much.